Thank you very much for attending the webinar today. My name is Alex Herbert. I'm one of the senior partners here at Holborn. We've had a lot of inquiries recently regarding alternative investment options. Obviously, markets are volatile at the moment, and we've had a lot of incoming inquiries regarding alternative options. Today's webinar is titled Predefined Income Strategy, and I'm going to pass you over to Tim Hayward, who's the Regional Vice President of Walton. Tim will be doing the presentation today and will introduce you to Walton, who they are as an organisation and exactly what it is that they do. Obviously, there is a Q&A. At the bottom of your screen, there is a Q&A button. Please feel free to send your questions in. There is also a chat function. Please feel free to send your questions in on the chat function. And at the end of the presentation, which I believe is 35 minutes, Tim?
Yeah, about that, Alex.
Okay, great. So at the end of the presentation, 35 minutes, we'll handle the Q&A and then we'll let you get on with your day. But like I said, thank you very much for attending. And Tim, I'll pass it over to you.
Thank you, Alex. Fantastic. And thank you, everybody, for attending this evening's webinar, wherever you might be. As Alex said, my name is Tim Hayward. I'm the Regional Vice President of Walton here in the Middle East, based in Dubai. As per the title, how to benefit from a predefined income strategy. And just to clarify that a little bit and drill down a little bit further, focused on real estate assets. And so what I'm going to talk to you today about is the Walton Group of companies, the US market, and of course the opportunities that we have today. So I think as a place to start, this is a really good snapshot, and it really gives you an understanding of what we're looking to bring to the party. We simply offer a fully packaged US land investment solution and partner with publicly traded home builders whilst targeting a 12 to 15% per annum IRR or internal rate of return, with a focus on generating cash flow distribution to our investors. Now, it's a very simple statement. There's an awful lot more to it behind the scenes that goes into that to get us to that point. But I think as a starting point, that gives you a really good understanding of what it is that we're looking to achieve and bring to your investment portfolio. First and foremost, though, Walton is a land asset management company. And so for over 40 years, we've specialized in land investment-based products. But understanding where land fits into the real estate life cycle is the first part of this process. And so really, when you look at the real estate life cycle, there are four key stages to that process. First and foremost is researching and acquiring path of growth land assets which are suitable for large-scale, cost-effective residential development. And so Walton takes an awful lot of time and research in making sure that we conduct significant due diligence during that first stage of the process. And what we're then able to do through our model is bring home builders in at that point who will then work with Walton and phase by phase take down the asset to then commence stages 2 and 3. So the horizontal development, where they put the servicing in, the water, the sewer, utilities, creating a fully serviced development lot to allow the home building to take place in stage 3. And then what you're left with is a fully developed out community, typically close to employment centers, amenities, and the like, and that completes the real estate life cycle. So just to reiterate, Walton's focus is specifically stage 1. We are a land asset management specialist, and I'll show you how we go through this process a little bit later on as we go through the presentation. Just some high-level overviews of Walton and what we bring to the table. We offer an asset-backed investment. It's backed by the actual land title itself to the project in which you may participate. It's a minimum investment level of $50,000, and it provides you with an opportunity to participate in really what is the largest housing market in the Western world. And whilst we understand that you may not necessarily wish to go and buy a physical home in the States, I think understanding the robust, mature market that it is in terms of real estate does give you an opportunity to participate without necessarily wanting to become a homeowner. And so the land asset that we bring to the table allows you to do so. Importantly, there's no debt on the land. It's a very clean investment. So we're not borrowing to go and acquire the land itself. So therefore, there's no, you're not subject to cash calls or interest rate fluctuations on the lending. So it's very, very clean from that sense. As I say, we've been in business a long time, over 40 years, in fact, over 43 years. And we've delivered a historical average annualized return of 12.23% per annum, which is audited by RSM Global. Now, I'm just going to pause here for a second just to be completely transparent and to clarify this statement, because this is our track record, but it is based on our historical model. And our historical model did not involve income generation. Our historical model was a buy, hold, and sell strategy, where we would still research and acquire the underlying asset, the land asset, but then the hold period might be 4 to 6, 5 to 7, 6 to 8 years, depending on the project, before investors would see any kind of return. And so again, just to be clear, our new model is based on income generation, but this is still an important part of our history, but I will show you what the new model has been delivering a little bit later in the presentation. We are also a Sharia compliance investment as endorsed by Amini Advisors out of DIFC in Dubai. So again, for the region, for the GCC wider region, that is a tick box which is nice to have, and we can satisfy that criteria. So just to give you a little bit of a background about Walton, as I say, we've been in business a long time, but really importantly, we've got a substantial footprint of assets across the United States and Canada. We originally were a Canadian company. We are now globally headquartered in Scottsdale, Arizona in the US, because the majority of our assets are in the US. And we have about 98,000 acres under administration, of which about 90% of that is actually in the United States. So we're close to our assets, we're close to the home builders that we work with, and we've got about 3.4 billion of assets under administration, and we've returned somewhere in the region of $2 billion back to investors since inception. And that is a number which continues to climb as we see more and more exit activity literally every week, every couple of weeks. We're seeing new exits coming about. And we've got a substantial investor base as well globally, which is of course testament to the distribution relationships that we have with groups such as Holborn. We really have 4 key steps to our process. First and foremost, as I've alluded to earlier, it's about identification of those land assets, which really is all about due diligence. We follow a stringent acquisition criteria before acquiring the property. We then syndicate those properties to investors with a predetermined exit strategy, with a home builder in position already, who's prepared to take that asset on a phase-by-phase basis, thereby protecting the value of the assets during the hold period and generating cash flow for our investors. And just to give you a flavor of some of the home builders we work with, these are the biggest and brightest home builders in the United States. You can see here a number of names, but I'm just going to point out a couple for you. In the top left corner, Lennar and D.R. Horton. They are the 2 largest home builders in the United States. They are both listed publicly traded companies. And D.R. Horton is the #1 home builder in the US and has been for about the last 19 years. And just to give you some context around that, last year, they built somewhere in the region of 81,000 homes across the United States. So it just gives you a kind of sense of the scale that the US home building market operates on. That's just one home builder. Across the board last year, there are around 1.7 million new homes built in the United States. So, it really does give you an understanding of the scale of the market. But we're very fortunate. We have very strong relationships with a lot of home builders, and that means that we can bring those assets to a number of different home builders. We're not tied to just 1 or 2. So just looking at the US housing market, just to give you a little bit of a feel for what's going on. And first and foremost, it's about understanding the opportunity, because whichever way you want to look at it, the US housing market is woefully undersupplied right now. And that is partly a fallout from what happened after subprime and the recovery cycle that the US housing market went through. But very simply, the US housing market is anywhere between 4.5 to 6 million homes short, depending on which industry report you read. So when you understand that, you can understand why there is that continued demand for housing. And really what the home builders are trying to do is ramp up production to meet that demand. But there are a number of headwinds and challenges along the way that they face, not least of all cost of timber or lumber, cost of labour, access to labour, supply chain challenges because, of course, of the COVID pandemic and things we've seen there. So there are a number of headwinds which are keeping a pretty tight lid on the supply side. Now, from our perspective, that's important and that's good because it means we're not in an oversupplied market. You know, there is a strong appetite for new developable land in the market, and it's not running away with us, which means it's more sustainable as that comes onto market to meet that demand. But the demand is really coming from the millennial generation, and the millennials represent over 82 million of the US population today. It's the largest cohort of the US population, and with a median home buying age of 33 years old, you can understand where this fits in terms of that future demand. Not only, in fact, future demand, but present demand as well. And so generationally, what we've seen is that, you know, as people are getting married, as people are having families, they tend to move a little bit further away into the suburban areas, a little bit further away where it's more affordable. And that is something which has been going on for generations. But what's happened on the back of COVID is that phenomenon has been accelerated quite substantially, because not only have you had a historic low interest rate environment in the United States for a number of years now, but as people are working from home more, and that's not changing anytime soon, people are looking again and they're reevaluating, and they're looking and saying, well, okay, if I'm working from home 2 or 3 days a week, I don't need to live downtown or need to live so close to the office. I can afford to live that bit further away. And as you move further away from the core areas, you find more affordability. Now, in an increasing interest rate environment, as we're now starting to see, that's going to play out to be even more important. And so that's something to keep in mind as to that sustained demand. When you also consider that 83% of all homes purchased are single-family detached homes, which require an awful lot more land because they're on a single development lot than, for example, a block of condos, then again, you can see how this all plays in to future land absorption. And 72% of all homes purchased are in the suburban areas. So again, it plays out talking about those things I factored in earlier. So all of these things are really talking about the supply and demand side, and ultimately we see a pretty robust story going forward. The other thing which has happened is the infrastructure bill, which has been approved. Quite how they managed to keep taking photos of Joe Biden with his eyes closed, I'm not sure. I was watching him last night and I thought, my word, God help us. But there we go. What you can see, though, is the way that the infrastructure dollars are going to be spent or allocated, shall we say. And so what you can see here is that the darker blue states are going to be the biggest beneficiaries of the infrastructure bill. Now, you might say, well, what's that going to do with housing and land absorption? Well, ultimately, these areas are growing for a reason, because the fundamentals of population growth, employment growth, housing growth are all playing their part in drawing people into these areas. And when you have growth in a region, you need to spend money on your infrastructure to keep up with that growth. And so it becomes a little bit of a snowball effect. Growth begets growth. And so when you look at somewhere like California, Texas, Florida, and Georgia, these are already significant areas and states, both in terms of population, in terms of GDP, all of those factors, and yet they're also going to be some of the biggest beneficiaries of this infrastructure bill. Now, the areas you can see highlighted in orange are Walton's target markets. And no great surprise, if I was to overlay the major home builders and where they're most active, you would see a very similar pattern emerging. Okay, so we are very much concentrated in the Sunbelt states of the US. There are a couple of exceptions there, outliers such as Illinois and Colorado, but for the most part, in the Sunbelt states of the US, where there is affordability, there is a lot of home building activity, there is employment growth, there is population growth, there is lower cost of living. And again, you don't need me to tell you this, you can do your own research and see this kind of demographic shift within the US. So, fairly topical at the moment, let's deal with the elephant in the room, inflation and interest rates. Fascinating subject, I hear you say, at 6:15 in the evening. Well, it's important to understand, because I think, you know, in anybody's portfolio, what you've got to do is look for some kind of hedge against inflation. And generally speaking, real estate is considered as a pretty decent hedge against inflation. And while volatility in the markets brings opportunity, of course, to take advantage of those drops, ultimately you also need to build in some stability and a hedge against that inflation. So we can see what's happening in terms of inflation. Now, highest level since 1982, 7.5%, pretty significant jump, something we're all going to be dealing with. And of course, you feel the pinch, just in your day-to-day life in terms of cost of goods, et cetera, at the petrol pump and the like. But what you've also got to take into consideration is mortgage rates. And again, the consensus could quite easily be, well, if mortgage rates are increasing, then surely that's going to have a detrimental effect on the US housing market. Well, again, I think you need to keep it in context. And so, yes, 30-year mortgage rates have increased, and they've been quite a jump comparatively or relatively speaking, and they have come from a historically low point. But when you look at them in the wider context, and this is going back to 1971, then relatively speaking, it is still quite affordable in terms of home buying. And so what you're going to see is, yes, there's some urgency going to be created in the market, because as interest rates rise, then people obviously want to lock in those rates before they jump up again. But again, overall, we're still looking at a fairly attractive long-term mortgage rate in the United States. So, we don't see too much of an issue here in terms of interest rates. And again, because we're not borrowing to go and acquire the asset in the first place, we're not subject to interest rate fluctuations on the asset itself. And the other thing I should just note in terms of inflation, which I didn't cover earlier, is of course, when you see inflation, you also tend to see home price appreciation. So tied in with that, when we're selling the land to the home builders and they're paying us a percentage of the home price for the lots, then again, you can see the benefit there for investors. So that brings me on to our pre-development land investment strategy, and it's really a six-phase process. I've alluded to it already, but the first part of that process is all about due diligence, researching the asset itself, researching the market, understanding the market, and then taking a position in a given market and sharing that due diligence with the home builders that we're talking to secure their interest in the form of a signed exit-focused agreement or letter of intent. Now, again, to be clear, a letter of intent does not guarantee anything. This is not a guaranteed product. But what the letter of intent does is it secures exclusivity for that home builder to allow them to work through the ongoing planning processes and work with the city and Walton, our engineering consultants, safe in the knowledge that we're not going to go and sell it to one of their competitors. And so when you're dealing in an industry which is all about securing market share, that exclusivity is worth its weight in gold. And remember also that the home builder is going to be spending substantial amounts of money from the moment they sign right the way through to actually paying out and closing on the deal. So it's in their interests to secure that exclusivity. What we then do is we present the opportunities to our investors through events such as this evening, where you're able to participate in a particular project or projects, depending on your budget, in the form of an undivided interest structure. That is basically a fractional ownership within the project for which you receive title deed, and Walton is appointed as your agent all the way through to act on your behalf, liaise with the home builder, and bring the home builder to the point where they're signing an option agreement. And the option agreement outlines the terms and conditions under which the home builder is going to take down the asset from our investors on a phase-by-phase basis, and what percentage they're going to pay of the home price. And that allows us to present a formal exit offer to investors, upon which voting takes place. And if 60% of the investors vote in favor or against the offer, it's binding on everybody. Now, I will just say here that when you look at a new project for consideration, you will have a projected cash flow and return associated with that. So by the time the actual exit offer comes out, you're going to know very, very simply whether or not it's in line or exceeding your expectations in terms of return and the projections that we've shown you. And therefore, it's a very simple decision to say, yes, I accept, or no, I don't. It then goes back to the home builder, who at their own additional cost completes the development plan agreements with the city and prepares ready for stages 5 and 6. And 5 and 6 are really all about the home builder taking down the asset from our investors on a phased basis, for which they will, generally speaking, pay a deposit of around 20% of the lots in that phase, and then they'll pay the balance payment as they sell the homes. Now, I'm just going to contradict myself here a second, because the project I'm going to show you tonight is actually what we call a phased bulk transaction, whereby they actually pay for the phases in bulk. They don't pay a deposit and then a deferred payment. And so it actually distributes proceeds quicker to investors. I'll show you how that works in just a second. So in terms of your investment, you're investing in stage 2. You've then got a 12 to 24 month period before you're going to see any kind of cash flow. And then the cash flow commences through stages 5 and 6. And that will go on for maybe 4, 5, 6 years, depending on the project. And again, I'll show you what the current project looks like in just a second. In terms of the security of the investment, well, that's all about the title ownership itself. So again, on a $50,000 minimum investment basis, you can see that you're investing into a particular project on an undivided interest basis, which is a fractional ownership, but for which you receive ownership of the asset through the registered title deed and the title insurance, which goes hand in hand with that, issued independently of Walton by First American Title Insurance Company. On the back of the sales and purchase agreement, you're able to nominate beneficiaries. And then again, as alluded to already, you have control through voting rights, and Walton is appointed as your agent to act on your behalf. So I talked about track record earlier, and I said I would come back to it based on the new model, the income model. This is basically a summary of all the projects which we've launched since 2019, when we made the pivot into the income generating model. 21 projects for just over 3,800 acres, a total offering size of $171 million. And these projects, just to clarify, have all closed now, so they're not available for current investment. And of those 21 projects, 12 of those are now at signed or draft option agreement or purchase and sale agreement stage. So they have either had offers presented to investors or they are about to. And they've generated a net multiple of just under 1.6 times, up to 3 times at the top end, and a net IRR at 10.87%, up to a staggering 44.36% per annum. Now, again, I'll just highlight that 44% to tell you that it's unusual. That's not the norm, so please don't fall off your chair getting too excited. But what it does demonstrate is the way that these deals can change sometimes. So what actually happened there with the project was that the duration of the payout from the home builder condensed pretty significantly, and that pushed the IRR up through, forgive the pun, through the roof. And that's what you can see sometimes happening. But in terms of what those exits have looked like, or those offers have looked like, what you can see here is a breakdown of all of those projects with just one, I think, not added yet. And you can see a couple of things. Firstly, the home builders we've been working with, which are all top 10 home builders in the United States. And of course, you can see we have a very special relationship with D.R. Horton, who is the biggest home builder out there. The other thing you can see here is the projected net return that we presented to investors when we launched the project to allow them to make an informed investment decision. And so that multiple, of course, if you invested $100,000, then we were projecting on Lee Farms that we would turn that into around $200,000 for investors, and so on and so forth, all the way through the column there. But what you can then see next to that is the actual number or the multiple which we've delivered to investors through the exit offer. So these top 7 have all now gone out to exit offer. They've been voted upon by the investors and they've been accepted. No great surprise, because they've all exceeded their original projections and their original underwriting. And so you can see here that while we projected 2 times for Lee Farms, we've actually ended up delivering a 2.52 times on a base level, up with a potential upside of 3.01 times, and so on and so forth all the way through. So some are a little bit more marginal than others, But again, I think it demonstrates the conservative nature of the way that we're underwriting these models, with a view to under-promise and ultimately over-deliver. The next projects down, the next 4 down, are currently under some form of option agreement or draft agreement stage. So they will be signed off fairly imminently, and we'll be launching offers on those next 4 pretty sharpish. And then the next projects down are, of course, still going through their processes. So really what we present here is an opportunity to participate in a land-based investment, which is going to be generating income, where we have a pre-identified builder for the future exit of the project. So it removes perhaps the more speculative element of it. That home builder prepares for development ahead of the exit at their own time, their capital costs, their resources, their sweat equity, if you like. And that, again, demonstrates their interest in the asset. And what it provides, therefore, for our investors is a clarity on the investment timelines, because you're able to see the projections of the project, you're able to see the timeframes of the project, and you're able to see who the home builder actually is. And of course, that ultimately generates capital gains from diversification into a low volatility alternative real estate investment. So with that, I'm just going to give you an overview of the current project, which is a pre-launch. We are due to be launching this, I believe, at the end of this week. So it's a little bit of a sneak peek of the project because we've run out of other inventory, which is a good and a bad thing. But this is a project called Adamson, which is in Coeta County, up in the Atlanta market. It's about 35 minutes southwest of Atlanta. So a hop out onto the I-85, Interstate 85, and you're down into Atlanta in 35 minutes. You're down to Atlanta Hartsfield Airport in about 30 minutes. But this is not necessarily about commuting into downtown Atlanta. It is a employment corridor as well. So people are living out in this area and working and employed in this area as well. It's a 500-acre project, and it's proposed for just over 1,000 single-family residences with a total offering of $23 million. And we are currently in the tender process with the home builders in terms of securing their signature on the exit-focused agreement. So we're currently talking to Century, D.R. Horton, Lennar, Pulte, NVR, and Dan Ryan, which is actually part of NVR. So all top 10 home builders in the United States, all publicly listed home builders. The exit strategy, as I've alluded to already, is a phased takedown on a bulk purchase basis, with cash flow starting from 2023 through until 2028, delivering a 13.38% per annum IRR for a 1.6 multiple. So just to zoom in on the project a little bit, just to give you an understanding of it's not in the middle of nowhere isolated. It is surrounded by amenities, by medical facilities, by school districts, by employment centers. And so really it has everything on its doorstep. You're not having to trip into Atlanta to get these things sorted. And this is very much the way that communities grow up in the US, kind of down and off these interstate highways, outside of these suburban centers. And just very quickly, you can see here the kind of supply-demand stats of the market. In terms of annual closings, you're at 29,170 for the year last year versus annual starts. So supply 30,027. So it's a pretty tight supply-demand balance. It's not oversupplied and it's not massively undersupplied either. But what you can also see here is the home builders active in the area. Those home builders represent the first, the second, the third, and then the 11th, the 12th, and the 14th active in this market. And that's important for us because we want to deal with home builders that not only have got expertise in the market, but have got the ability to close and have got the capital to develop out these communities. And again, just a snapshot of those home builders. But I think it demonstrates, based on the 2020 closings, you can see just the significant size of D.R. Horton in comparison to what are other top 10 home builders in the US. And when you look at Lennar numbers versus D.R. Horton, you're talking a considerable difference between the two. And that's your number one and number two home builders. So it just gives you a sense of the scale of D.R. Horton. Also, just give you an idea of what's being built around the area. And again, because you're not there, perhaps you don't know the US market, but you get an awful lot of bang for your buck in terms of US housing. And you can see that these properties by D.R. Horton are just 10 minutes from the asset, $352,000. Gets you a fair amount of house in the US, but not only house, it gets you the amenities, the trails, the parks, the clubhouse facilities in these gated communities. And again, Lennar offering a slightly higher price point here, $384 up to $503,000. Again, just 10 minutes from the property, but again, very heavily amenitized master plan communities. And that is really what the US home buyer is looking for. In terms of the cash flow of the project, and again, this is subject to final confirmation, but what we expect it to look like is something like this based on the discussions with the home builders to date. It's a bulk transaction. So on the left-hand side of your screen, you can see the project numbers. So in 2023 through to 2027, it's expected that we'll deliver 170 lots to the home builder, for which they'll pay a bulk payment of just over $6.4 million. And then in 2028, 168 lots, the balance of lots for just over $6.3 million. And that will be distributed to investors, of course, pro rata. So if you jump across the right-hand side of your screen, you can see, based on a $50,000 investment, which is, of course, the minimum, you can see that the cash flow would be projected to come back to investors in each of those years. Pretty consistent numbers all the way through because of that bulk phased sale. So on a $50,000 investment, $80,092 coming back for a $30,092 capital gain. And just to clarify here, this is actually a return of principal plus growth because the principal is paid down over the course of the duration. So you don't suddenly get a $50,000 payout at the end. It's actually distributed as part of proceeds all the way through. Hence the kind of healthy IRR numbers that you can see there. So that is the main part of the presentation. Alex, before we open up to Q&A, what I thought I'd do is just cover off the tax side of things, because I'm sure it's a question that will be asked. So if you just allow me to jump out of this presentation, and I will put this one up on the screen for you.
Okay, that'd be great. Thanks, Tim.
Can you see that, Alex?
Yes, I can, yeah.
Right, okay. So there's a couple of things to highlight in terms of the US tax situation. And yes, there is tax to pay on this disposition of this asset, but please don't worry, it's not as scary as you might think. First and foremost, the US system for a non-US person works on a 15% withholding tax basis. And that is to say that 15% of the gross proceeds will be withheld at source, pending filing of your actual return, and obviously any application of your associated tax rate. You're also, because of this, because of the federal tax allowances, you're able to benefit from a $40,400 per year per person federal tax allowance, which is to say that you can make a capital gain of $40,400 per year federal tax free. The final thing to keep in mind here is that because this is considered as a long-term real estate hold, i.e. it's held for more than 12 months, it straight away qualifies as a under the long-term real estate rate of 0 to 20% tax. So with all of that taken into consideration, this example is based on a 50,000 example, and you can see the net proceeds, which are net of our fees and before tax, which are what I've just run you through here, okay, for $80,090. And then if we jump across here, you can see the withholding tax being applied out of those gross proceeds. And so $2,482 will be withheld at source in each of those years through to 2027, and then the final amount of $2,453 in that final year. But what you can then see is through the filing process, you're getting the vast majority of that withheld amount back in the following tax year. So at $14,862 withheld, you're getting $14,862 withheld, you're getting $14,096 through the refund process. And the way that the refund is handled is you're able to nominate RSM Global Tax Advisors to do it for you, and they will charge, it's actually now $100 per year for any project that's over $20 million, which this project is. So that would actually be, in this case, $600. And so on $80,090 net of fees but before tax, you're actually looking at $78,424 on a net basis. So I think that, you know, only the most unreasonable person would think that that's punitive. I think it's quite generous, actually, and I think most people are pleasantly surprised of the tax treatment. But again, because of those allowances and the thresholds I talked about, that is why it's treated the way that it is. So with that, Alex, over to you. And if you want to open the floor up to any questions, I'm happy to answer them.
Thanks a lot for that, Tim. It's really good. We've had a couple of questions come in, but there hasn't been too many. So if I could just remind you, if you do have any questions, please feel free, send it through and we'll try and get them answered. A couple of people have asked if this has been recorded. Yes, it has been recorded. We will be distributing it over the next few 24 hours, I expect. So for those of you that would like a copy, we will of course send you a copy. We've got a list of everybody that's attended the webinar with your email addresses as well, so we can send you a copy through. Okay, so let's start. So the IRR of 13.38%, is that net of taxes?
No, that is net of fees, but before tax.
Okay.
Yeah. So in fact, if I just pull up this previous screen, Alex, you can see here that the impact of tax on the IRR. You can see that pre-tax is 13.4%. Net is 12.2%.
Okay, perfect. Thank you for that. A couple of, we've got quite a few coming in now, Tim. Okay, so what's the due diligence process? And in terms of nationalities of people who can buy this product, is there any limitations?
In terms of nationality of individuals, no, we are pretty open and inclusive. We accept every nationality. With the caveat, of course, that anybody that might appear on an embargoed persons list or anything like that, then of course the US will do their checks. Then of course we're subject to those normal checks that would be undertaken. We can also accept business from American expatriates. So if we have any US nationals, US citizens who are on the call residing overseas, then at the time of investment, as long as they are overseas and they're residing outside of the US, then they can also invest.
And what's the, just quickly on that, because another question's come in, what's the tax implications for a US connected person who is living outside the US?
Yeah, so a US person, I'm not a tax advisor, but certainly a US person would not be subject to the withholding tax requirements, which generally speaking would be favorable because of course then you've not got 15% withheld at source. And you don't have to file for recovery of it. It would typically, I believe, just be added to your normal income tax reporting and will be treated accordingly.
Okay, great. And what about duration of investment? I know the answer because I know you've got numerous different projects that all are different timing, but what would you say about the duration of the investment typically?
Yeah, so historically, our average duration was around about 8 years or so. Based on the old model. With the new income model, it's, I would say, about 6 years is pretty typical. The difference, of course, being is that from pretty much 12 to 24 months in, you're going to be seeing an annual income being generated.
Okay, and I mean, we've had someone ask about lock-in periods. Obviously, once you buy the project, you're locked into the end of the project, right?
Yeah, and I think it should always be viewed as that. I mean, I think once the income starts, then the question would be, well, why would you want to get out? Because if it's paying you a nice, healthy income stream, then there's probably other assets you might have that can give you perhaps more liquidity. But again, if it's generating liquidity for you anyway, then it probably answers some of your liquidity needs. But yeah, it really is a buy and hold strategy, and it should be considered as such.
Okay, I got a couple of really good questions here from one of our attendees. In terms of repatriability of the funds, i.e. sending the income out of the US, is that straightforward or is there any restrictions? And also, same question, or same attendees asking, do they have any choice on selecting which states the investment should focus on?
So in terms of repatriation of proceeds, we can pay to any nominated bank account of your choice. So If, for example, you have a bank account in Dubai, in the Isle of Man. I, for example, have an account with HSBC in Hong Kong because I lived there for 18 years. So you can choose. It's entirely up to you. So there's no restriction on that. And in terms of the state, in terms of where the asset is, yes and no. You can choose based on the areas that we go into, but we're not going to go shopping for somebody. So, if it's not a state that we don't believe in or that we don't, actively acquire assets in, then no. And also it will be determined by the inventory that we have available. So right now, as I say, we're about to launch the Atlanta project, which is Georgia, of course. We would generally like to have 2 projects available at any one time, which does give that diversification in terms of region, which perhaps answers some of your question. And you see that clients quite often build a portfolio with us with different locations, therefore states, different home builders, different timeframes, etc. So you can diversify across different states based on where we actually acquire assets. Yeah.
Okay. And is this an investment for individual persons only, or can companies invest into Walton? And more specifically, what about a US company?
Yeah, so in terms of individual versus company, both actually. The thing you need to consider is that why would you do it as a corporate? If there's a compelling reason, then fair enough. But from a tax perspective, you're going to be taxed at base level 21% versus between 0 and 20% as an individual. So as I say, I think there'd have to be a fairly compelling reason to do it. And also it would only make sense if you're looking at investing sort of upwards of $500,000 and above because of those reasons mentioned. In terms of a US corporation, no, because again, it would come down into the resident status and anything in the US would be considered as resident, whether it be a company or an individual.
Okay, great. And can the investment be funded from a US bank?
Yes, it can.
Okay, great. Okay, if the letter of intent doesn't go through, so if a home builder supplies a letter of intent, but then for some reason it didn't go through, what would happen, and has that happened before?
Yeah, it's a good question. And I think, again, it's just worth reiterating the fact that a letter of intent is just that. It does not guarantee anything. And it can happen. It has happened once so far. And in fact, I'll just show you, if I just go back here a second. Yeah, so you can see here, in fact, it still shows as Princeton there, but it's not. Okay, so Princeton was one where actually D.R. Horton were the original home builder on it. And they came to us and they said, look, we've got an asset, we need to move on quicker. We still like Princeton, but we're just pushing it back a little bit further. Are you okay with that? We basically said no. So we cancelled the LOI and we went back out to the market and we very quickly replaced them with another major home builder. And so, again, this comes back to our strength of relationships with home builders who are vying for position. And so if you look at the current asset, Adamson, we've got 5 different home builders involved in this project. So whilst we might sign with one, if for any reason that LOI did fall off, then we would be able to go back to all of those and give them an opportunity to participate. So that's how we'd handle it.
Okay, great. Is Walton listed, Tim?
No, we're not. We're a private family-run business.
Yeah. Okay. And okay, so the new project that you've spoken about, which is launching in a week, for any people that want to invest into that project, who are already clients of Holborn, do they have to wait for the official launch date of that, or can they arrange that investment immediately?
Yeah, so they can submit a reservation form ahead of time. And of course, because if they're existing clients, then we've got their personal particulars on board anyway. So it's just a question of a reservation form. We should be launching this. I've got a call at 5:30 a.m. tomorrow with North America to actually launch this internally. So I would imagine by the end of the week, we'll have all of the materials to distribute out to anybody that's interested.
Okay, perfect. And do you provide the tax docs, the 1099 for US citizens?
We do. So part of the process upon exit is that any tax documentation which is required, we would provide and send. But ultimately, for a US person, of course, it's generally speaking their responsibility, and they probably have a tax advisor or accountant already in place, and so it probably would be easier for them to deal with them. But we will provide the documentation that they require. Yes.
Okay, great. Thanks a lot. Okay, we've had loads of good questions there, Tim, haven't we? I think that's excellent.
Yeah, brilliant. Absolutely.
We haven't had any more come in, so I think we'll. What's the time? Yes, we're 10 minutes before schedule. But obviously, on behalf of Holborn, everybody, thank you very much for attending the event. Really, really useful. I mean, I've known Tim, and I've sat in Tim's presentations for a number of years now, and every time I sit in a presentation, he makes it very interesting, easy to understand. So, Tim, on behalf of the company, thank you very much for taking time out today and presenting to us. It's been excellent. Obviously, for everybody that is on the call, if you do have any interest in what Walton do, which I'm sure you do, that's why you're here in the first place, please reach out to your advisors and they will do everything they can to put you into touch with Tim. Tim will also be very helpful. He can jump on one-to-one calls with you guys if needs be. So yeah, I'll leave it with you. Thank you very much for your time this evening. All the best, and enjoy the rest of your evening. Cheers now. Bye-bye.
Thank you, Alex. Thank you, everybody. Take care. Bye-bye.